Good morning, restaurant owners. Welcome to this week's Facebook Live training for you, independent restaurant owners, on how to use the accounting and finance to improve your profits and cash flow. Let me share my screen and we will move on to this week's topic, which is mastering your restaurant's profits and cash flow. And I use the word mastering because to master your restaurant's profits and cash flow requires several components of the accounting and finance coming together to analyze the day-to-day operations of your business, utilize tools that we're aware of that we can help you implement to improve profits and cash flow. Part of the process of mastering is the two components that we're going to cover today. So join us weekly, every week for these Facebook Live trainings, every Wednesday at 9:30 in the morning. We'll explore essential financial management topics for restaurant owners through a concise 15, 20 minute, sometimes even 40-minute sessions. So join us, come back here every week and join us for the live training. We also send out to our contact list a recap email that recaps what we've covered and gives you opportunity to click through and watch the recording. So let's move on to the topic, understanding profits and cash flow. So cash flow basics. Cash flow is a comprehensive financial management result. And it's vital to understand it's vital for your restaurant's stability, but isn't the same as profit. So profit appears on the income statement. Cash flow is a combination of your bottom line profit and how that profit is manipulated as it works its way through your balance sheet. So cash flow is measured through balance sheet changes. Part of a balance sheet change is the net income from that month's P&L. So one of the profit fundamentals, our cash flow fundamentals, is positive cash flow requires healthy profits. All financial stability starts with consistent month-over-month profitability. And of course, the higher profit, the higher the cash flow. But I want you to understand that cash flow is impacted by moves on the balance sheet. And we do this training every week. Sometime in the next couple months, we'll cover the balance sheet basics so that you can understand when you sometimes look at your P&L and there's a bottom line net profit, why hasn't your cash balance increased by that much over the course of a month? So with that understanding, the two pillars of financial stability, the two pillars of improving cash flow are proper systems set up, establishing strong financial structure, and then planning for profit. Budget management, the number one tool to optimize profits and cash flow is utilizing a business plan. And from a bean counter's perspective, that means a budget. And we look at that as more than just an income statement budget. We're managing cash flow by projecting out and forecasting not just the income statement, but the balance sheet so that we understand how, when your bottom line net income flows through the balance sheet, how does that impact cash flow? And like I said, we'll get into that in another training over the next couple weeks. So optimizing your accounting systems. Here's the basics. You need to track the critical categories. Monitor sales and cost of goods sold by category, individually by food, beer, wine, liquor, non-alcoholic beverage, any retail products if you sell them in your restaurant. Each of those gross profit margins needs to be understood, analyzed, and improved over the course of time if possible, and it's always possible. Separate back of house and front of house labor tracking so that you're looking at the back of house and front of house as a percentage of total sales and what tools can we implement to improve that as a percentage, as a cost percentage of total revenue. We need to track direct operating expenses. Those are the expenses other than your product cost, your food, beer, wine, liquor, and a bev, your back of house and front of house labor. Those are the other direct operating expenses that you are in control of. They fluctuate with volume level, and you have the opportunity to control those expenses month over month. And then we get into overhead expenses, which are mostly fixed cost. We're going to dive into that a little bit further here in a minute. So implement a detailed chart of accounts, go beyond the basic GAAP, generally accepted accounting principles, that your tax accountant probably wants you to follow. Go beyond those requirements and create a detailed chart of accounts that gives you the category breakdown that you need to drive meaningful analytics and KPIs, key performance indicators, or financial metrics, however you want to think about that. So set up your chart of accounts so that we're driving meaningful information so that we can make informed decisions on where your restaurant is at, what are your operating efficiencies and inefficiencies, and what tools can we implement to improve those results. Use accrual-based accounting. That's kind of an accountant nerdy term. I'm not going to get too much into that, but basically it means recording expenses when they occurred, not just when they're paid, so that your key vendor delivery of food on the 30th of the month, you're probably not going to pay that on a cash basis until sometime in the following month, but that's actually an inventory hit in the current month. Or if you incur some consulting expenses at the end of the month. That's a current month expense, even though you're not going to pay for it the following month. Then the other key part of accrual accounting is that your pay periods, your payroll pay dates, don't necessarily correspond exactly with how we're measuring your operating results for a period of time, for the month or for the quarter. So your accountant, this isn't something that you need to do, but your accountant should be doing this, calculating accrual-based entries so that you're posting those journal entries so that the month that you look at, you're actually capturing 30 or 31 days of payroll expense, not just two pay periods, which is only 28 days, or in some months, three pay periods, and that month's going to look real lopsided as far as your back of house and front of house payroll expense. That's enough of accrual accounting. That should be something that your bookkeeper, your accountant, or your outsourced accountant is taking care of for you, and more than just for payroll, for all aspects of your bill pay. And then align the point of sale system with the accounting general ledger package. Configure your POS system to match your chart of accounts for seamless data flow. And those two systems should be synced up and integrated so that when the point of sale system is closed out for the day, it's feeding your accounting system currently so that you're looking at the next day real-time results on your sales. So that, let me move back a screen. That is optimizing your accounting systems. Let's move on then to creating your operating budget. This is the number one tool that you're going to use to understand where you're at today in your operating results, looking out in detail over the next 12 months, and what can we do to improve our cost percentages, improve that bottom line profit, which, as we've just talked about, flows through and improves cash flow on the balance sheet. So create your operating budget. You want to start with defining what does success mean to you and your restaurant. Create a plan based on your restaurant's unique conditions, your core values, your style, your price points, your location. What does success look like to you in 12 months? Where are you at today? A detailed P&L analysis. And what can you get to in 12 months? You know, the average independently owned restaurant ends up with about 5 to 6% bottom line net income profit or worse. The big boys, the big chains are shooting for in each individual location anywhere from 15 to 20% bottom line profit. So let's say you're at 7% bottom line profit today. As we build that budget over the next 12 months, what tools and levers can we pull to improve that bottom line profit so that, say, in 12 months, you're at 12%. And then the next 12 months, you're working towards 16% or what have you, so that you're starting to get the same bottom line profit as your largest competitors and what the sophisticated restaurant groups are shooting for. Choose your tool. Select a budgeting software that works for you. Some options include QuickBooks Online has a budgeting tool. It's somewhat limited. We don't really use it. You could take your P&L out to Excel or Google Sheets and try to build a budget that way. And I've done it in the past. I'm somewhat of an Excel guru, not a sophisticated Excel guru. But even if you are a sophisticated Excel guru, the problem with Excel or Google Sheets is one wrong cell or one corrupt cell that includes a calculation corrupts the whole sheet. We use a tool called Fathom, which syncs directly with QuickBooks Online. It takes all your data out of QuickBooks, and then within that tool, you build an operating budget, and it offers a lot of flexibility and creativity in building that budget. So build your template. Start with historical data. If your proper chart of accounts, COA's chart of accounts, if that's not in place yet, and by the way, we do a separate training on what is the proper chart of accounts and what are some other basics to set up that foundation of a good accounting system for your independently owned restaurant. If that's not in place yet, go to your point of sale. There's all kinds of information in your point of sale system. You can analyze your sales mix from there, and you can track cost metrics from your accounting system and incorporate payroll data. So the detailed 12-month operating budget, create your plan. Look at the previous 12 months P&L, month over month, as your foundation. Here's where we're at today. Here's what we've done the last 12 months. And by the way, it's December. It's the perfect time to build your budget for 2026. But we're always looking at where have we been the last 12 months and where are we looking over the next 12 months, no matter what time of year we're at. We're always want to be looking out 12 months, even if it's May or October. Project the next 12 months P&L and always start with sales. As your, for our clients, as their supported accounting team, we don't really control the sales results. We're not marketing people. We're not, that's up to you, is to improve your sales results. So we rely on you to project out the next 12 months of sales. Then we work with our clients to identify improvement areas and create an actionable plan. Those improvement areas and an actionable plan starts with variable expenses. So your prime cost, your food costs as it is compared directly to your food sales, wine, beer, liquor, non-alcoholic bev costs. Where are they at today? Where should they be or could they be over the next 12 months? And then we want to implement some tools to impact those cost percentages. How can we improve them gradually over the next 12 months? Then we're going to want to look at your direct operating expenses. As we talked about, those are variable expenses that you can control on a month-over-month basis. It might be your front of house supplies. It might be what have you. That's the best example I have of direct operating expenses off the top of my head. Variable expenses, there are some other variable expenses. If you're on a percentage rent lease contract, your merchant processing fees, those are going to fluctuate depending on your monthly sales. If there's some seasonality in your sales, we want to build that seasonality out over the next 12 months. And there always is in the restaurant business. And those merchant processing fees, those credit card fees fluctuate up and down depending on your sales level. So we build those variable expenses into the month-over-month detailed 12-month budget. And then you come down to your fixed expenses where at best you might have an opportunity to impact those once a year, whether it's an annual contract or in the case of rent, the standard monthly rent, that's probably a 3 or 5 year contract. Insurance premiums, telecom services, equipment leases, some of those things you can't really impact until the contract date comes around. So you're breaking down the detailed P&L month over month budget and looking at what are the sales levels, how can we impact costs, especially those variable costs, prime cost being the biggest, lowest hanging fruit that you can impact the bottom line with, variable expenses, and then plugging in the fixed expenses. So continuous budget monitoring. This is where it becomes the tool for you to really impact your bottom line. Every month, you want to review the actual performance against the planned targets monthly. And notice I said planned targets. It's a budget. I don't really like that word. It's kind of a dirty word. Most people turn their nose up when they hear the word budget, but it's actually a plan, and there are targets involved in that plan. And how can we improve the bottom line profit? And by the way, when you start to see that 12-month plan, it motivates you to stick to some of the hard decisions you have to make to achieve those lower cost levels, um, whether it's trimming your team or rearranging your team, making decisions to implement tools to reduce food costs, to reduce your liquor, beer, wine costs. It's a motivation when you can visualize what some of those changes will mean to your bottom line. So you compare monthly, planned versus target, the budget, analyze, investigate the variances so you understand the root causes. What systems or tools or improvements did we want to implement, and have they been implemented? And maybe that's why we're off on the results, because we haven't implemented as fast as we wanted to. Maybe there's some changes in the team and those changes didn't work correctly, and we're not seeing the desired results we wanted to see. Or maybe the plan just wasn't realistic. There are times when you have to adjust the plan. Remember, we're always looking out over the next 12 months. So we have the ability, and we usually try and limit this to quarterly, to change the budget, change the plan. If when we did it back in November and December for the year, our understanding of where we were going to be wasn't realistic. So understand the root causes for the variances, adapt, modify your operations to get in line with some of those tools you were going to implement. And there are several trainings here in our weekly training on what some of those tools are to impact your cost percentages, gross profit percentages. We either have to modify our operations to get in line with what we plan to implement, or like we just said, maybe the budget is based on unrealistic findings. That should be a word inserted there. Repeat, continue the cycle for ongoing improvement. Every month, we're comparing actual to budget, we're analyzing those variances, and we're adapting the plan, adapting your operations or adapting the plan, repeating this over and over and over so that you're using this as the tool it's meant to be to improve your bottom line and improve your operations and enhance your lifestyle. Okay, the key steps to financial mastery. And these are just four of the key steps. There's many steps involved in overall financial mastery. I should say key steps to financial mastering. These are some of the steps along that process to achieve robust financial health. Grasp the fundamentals is number one. Clearly understand the distinction between profits and cash flow. Today, we're focused on profits, on the income statement profits. We're going to do another training that helps you understand how your net income bottom line profit flows through the balance sheet and ends up ultimately in cash flow. So grasp those fundamentals. Make sure you're optimizing your accounting system so that it's built for an independently owned restaurant. You've got a detailed chart of accounts. You're using accrual accounting. You've aligned your point of sale system or any other systems like your payroll so that it's precisely tracking all of the financial categories so that you're getting the measurement on all those key metrics, those key KPIs. So craft your budget is the next step. Develop a realistic 12-month operating budget, projecting sales and categorizing variable and fixed expenses. Build in improvements to improve profits, to improve your bottom line, so that you can visualize where you can end up in 12 months. Monitor and adapt, continuously compare actual performance to your budget, analyzing variances and adapting strategies for your ongoing improvement. This is the foundation to starting to mastering your financial management of your restaurant. So join our financial management community. Like I said, every week we're going to be here, 45 annual sessions at, 45, 46, maybe 47, maybe 42, depending on how much time off I want to take. 15 to 40 minute per session, and 100% restaurant focused content tailored to your industry. Every Wednesday at 9:30 in the morning, come back here. And for our contact database, if you'd like to be part of that, let us know. We send out a reminder, and these are recorded, and you can go back and listen to the recordings. So, what's your next step? Book a profit and cash flow analysis meeting with me. I love talking to restaurant owners. It's a no obligation meeting. We'll look at your current systems, identify your biggest opportunities, and map a path for more profit. Most restaurants, if your restaurant is doing a million or more in annual revenue, we can usually find 25 to 100,000 in hidden gains towards the bottom line. I would say 1.5 million in annual revenue. So I'm going to drop a comment um, below this recording, below this video, that will have a calendar link, a link to my calendar. Book a time. Let's get together and discuss your restaurant. No obligation analysis of what's going on in your restaurant. And I would love to talk to you. That's it for this week. I'll see you next week for another live Facebook training on how to use your accounting and finance to improve your profits and cash flow.